So one of the things that has had a bit of press speculation around the budget is this idea of an exit tax, where people leave the UK and somehow end up having to pay tax at the point in time that they actually depart the country and cease to be a UK resident. And that this definitely seems to be something that has potentially been on the government's agenda. And obviously, since the tax changes that came in last year, there has been a lot of talk about millionaires and billionaires leaving the country, going to live in the United Arab Emirates or the Isle of Man or wherever else where there's a more advantageous tax regime. And I guess the exit tax is potentially part of the government's response to that, to try and claw back some value from people who are leaving. And it may be a bit of a surprise, but actually the UK is possibly quite unusual in that we don't currently impose an exit tax. There's a lot of jurisdictions around the world that do, in certain circumstances, impose exit taxes when people leave the country to go and live elsewhere. So Australia is one, Canada's another. There is something in the US around that, and a number of other jurisdictions do that as well. And quite often the way that it works is that at the point in time that the individual's leaving, the government would look at all of the assets that they've got in their kind of estate from a capital gains tax point of view, and potentially from any UK assets they would kind of leave those out, because from a UK perspective, if you've got property in the UK, land or property in the UK, you'd still be subject to capital gains tax on that, whether you're a resident here or not. But they might look at other assets which aren't within the UK tax net. So that might, for example, include shares in companies, it might include properties that are overseas. And what the exit tax might do is say, essentially, from a UK tax point of view, you're almost deemed as if you'd sold those assets at the time that you leave the UK for the market value of those assets at the time that you leave. And that would effectively then give rise to a taxable capital gain. It's much harder for companies to leave the UK and cease to be a UK tax resident, but there are actually similar provisions. So if a UK company migrates to sort of use the common terminology over to another jurisdiction, then that same thing happens. It's deemed to have disposed of all of its assets which aren't within the UK tax net at the point in time that it leaves, and pays tax on the basis of the market value of those assets. So you can see that potentially could be quite a significant disadvantage for people actually leaving the UK if they end up picking up quite a significant tax hit as a consequence of it. Now, whether this will actually come in or not, who knows? I think the other side of the coin for that is, in a lot of these jurisdictions, and I can speak from personal experience of working over there, but in Australia, if you become an Australian resident, at that point you're deemed for Australian purposes to have bought all of your assets at their market value at the date. So if you're then deemed to dispose of them when you leave Australia, you're only really paying Australian tax on the increase in value between the time that you arrive and the time that you leave. So I think if the government did look to introduce an exit tax, I think it would only be reasonable to also allow people coming to the UK to live the ability to kind of step up the value of their assets for tax purposes to the value when they arrive. So again, they'd only pay tax on the capital gain that actually arose while they were actually resident in the UK. Now, as I say, it's only speculation at this stage. We've not seen any more details, and as we know, there's a lot of speculation about a lot of things going on at the moment. But if there is a genuine concern about the flight of wealth from the UK, then this could be one way in which the government does try to recoup some value from the people who are heading overseas.